Take it away.
All right. Thank you, Jeanette. Good morning, everybody. It's always a pleasure to be in these TradeThirsty events and privileged to lead it off here, as Jeanette said, on the final one of 2018. Everybody's talking about what's going to happen in 2019. And the great thing about what I want to share with you today is it really doesn't matter. What matters is that you're flexible enough to take advantage of opportunities on either the bull or the bear side when the opportunities present themselves. For me, one of my absolute favorite vehicles, and it's been tremendous this year. Everybody thinks, well, last year was easy. This year's been hard. But this year's actually been more profitable trading our FANG option trades, bull and bear. But you have to be able to trade the bear side as well as the bull side. And that's what I hope a lot of you are able to do already. But if you're not, this is hopefully going to open you up to a whole new world of opportunities. Now, we're going to talk about the big 5 FANG names: Facebook, Amazon, Apple, Netflix, and Google, and go through a lot of case studies today. But as we do, just a reminder that everything that I share with you today is for your information and education only. Nothing we're talking about here should be considered a specific recommendation to buy or sell any particular investment. Of course, you know that you are solely responsible for your own investment decisions. That's why you're here this morning, to learn new strategies and things you can take advantage of going forward. But not all big trends products and services are appropriate for all types of traders and investors. So always keep your risk level in mind. We're going to talk about how we manage risk with these FANG options trades, because these stocks do move quite a bit. So we'll talk about how we manage it proactively. We have big trends. We don't provide any personalized financial, tax, or legal advice either to any individual. What we do is we take our FANG options research, we fire out real-time emails and real-time text alerts to your smartphone that allow you to take advantage of those as you see fit. And it is end of the year. It's tax time. According to my accountant, after December 31st, he just becomes a historian. So it's a great time to consider a lot of these trade alert services and other investments you make to enhance your financial future can be up to 100% tax deductible, depending on your situation. Check with your tax advisor and see if you can take advantage of that and get an end-of-year tax deduction if you act quickly. Now, what we're going to talk about today is what are the FANG stocks. If you've been under a rock, you don't know what I'm talking about. We'll get into the basics of it quickly, but then we're going to go into some of the core benefits of why I like to use weekly options, especially on these higher dollar stocks. In fact, I really think that the high dollar stocks are where you should love weekly options, because you can get tremendous bang for your buck. You don't have to be committed for any long period of time. And then it's just about option selection to make sure you're not doing anything just insanely risky, really managing your risk very carefully. We'll talk about how we do that. I want to give you today a really meaningful specific that you can walk out of here and say, you know, it wasn't a sales pitch here. It was a true education lesson about what's a technique that you can use on any time frame. I'm going to show you how I do it with the FANG names. You could do this on your portfolio for the best stocks out there for the next month, the next 3 months, the next year, to the upside and to the downside with this indicator I'm going to share with you today. And then loads of case studies. It's all about modeling success. And, you know, and the reality is it's also about knowing what doesn't work too. So when you see something that no longer fits what I call your success profile, I'm going to share with you today for this FANG options approach, you should get the heck out and get back to the sidelines, wait for your next proper setup and follow through. Now, if you're new to the FANG moniker there, of course, the original 4 FANG stocks, Facebook, Amazon, Netflix, and Google, make up how they came up with the name FANG, but we've always thrown an Apple in there. You're starting to see more FAANG kicked around there because so many people now also include Apple like we have for the last couple of years. But bottom line is that you know, there's probably other names that you could theoretically start to add onto this list. I don't know what they would become. We were joking around if you threw in you know, some other ones. You could eventually come up with something like Batman or something. But basically, right now, let's just focus on these big 5, because these big 5 are where there's tremendous, not just opportunity, but there's tremendous liquidity. There's an ability to get in and out really, really easily in these names, not just in the stocks, but in what we're focusing on in the options. All of these big FANG names have weekly options, not just for this week and next week, but for the next couple of months. They've got weeklies listed out there so that the liquidity just keeps building and building. And you say, why should you care? Well, if you look at what we've done over the last just over 2 years, over 28 months since we launched this program, through just this past week, total profits when you add up all the gains and losses before your commissions, $8,355. Now, we're averaging in the neighborhood of about, I'd say, 7 or 8 trades a month. So in the neighborhood of up to 100 trades a year. So over a couple of years, talking about a couple hundred trades. Factor your commissions accordingly. If you're paying too much for commissions, you should check with Chris Sayre, my lead consultant, who should be in on. I see he is in on with us. He'll help answer questions in the chat. He can point you to brokers that can get you in and out very effectively and automatically without you having to follow this stuff intraday. If you are occupied with a day job, not full-time trading, you can still take advantage of this. That's called auto trading. More on that later. But bottom line is that you say, well, that was over the last couple of years. What about this year? This year's been even better. We've made more than half of our profits in 2018 over the last 2 years plus. And you see, it's not a straight up line. We've had the occasional give backs. But the nice thing is that, even while, we saw a little bit of chop in the middle of the year, you can see we really took off in the last couple of months when everybody else was kind of losing their shirts and going from positive to negative on the year, on the indexes and on a lot of other people's strategies. I talked to a lot of traders who've been frustrated getting whipsawed or chopped in this market. And so the key is you got to know how to take advantage of this when the pattern is right, when it's not right, how to get rid of it and move on. Now, we even broke it down by month because I want you to be able to visualize a little bit of, again, all the profits and losses added up in any trade from the month that was recommended. And you can see that most of the time our losses are pretty contained. You can see that September was probably our worst loss. Most people would just focus you on their gains. I want you to actually start looking at the red first and say, okay, what's your typical kind of medium loss look like? And you can see about down 5 or 6% on a portfolio. We use about a $10,000 base. So you can see there's a 686, there's a 560. If you're not, there's an 800, and September, like I said, was down about $1,400. That's not fun. But the reality is we made all that back in October and then made even more in November when the market just kept dropping. So if you give up after a drawdown like September, you're going to leave the best opportunity that's ahead of you, to somebody else, and you're going to miss out. Obviously, also, of course, on the size of gains, January 2,600, March 1,600, July 1,900, we expect to make on average about twice as much on a typical winning month compared to what we lose on a typical losing month. So it's just about making sure you've got it, we've got about the same amount of winning and losing months. Hey, you can still make a lot of money on a trend trading approach like this. Now, what are we going to talk about today? We're going to talk about one specific pattern. I'll get into more of the nitty gritty behind these indicators, but it's about this green line here. This is the one line I want you to focus on today more than anything else, and that's the ADX. It's the average directional movement. ADX is widely misunderstood. It was developed by Wells Wilder decades ago. And the beauty of this is that it shows you when the markets are starting to trend if you use it properly. A lot of people will say, well, ADX is a sign of the trendiness of a market, and they'll wait until ADX gets up over 30 or 40 even, and some people say. And my point is, by then you've missed the move. Even if you waited to 30 here, you see you're already, you could have made some money before you caught then that next gap down. We made 109% on Netflix in 2 trading days, in one morning, out the next morning. So the beauty of this too is that we try to avoid day trading. We don't actually want to day trade unless we get a double in a day, then we'll take it, sure. But I don't want to purposefully day trade. So the beauty of this is that we want to take advantage of multiple day moves here. This is going to average about a 2 to up to 3 day holding period, but 2 days is probably about the norm. Win or lose. Occasionally we get stopped out in the same day too. So we're always sensitive to even smaller accounts that don't want to be labeled as day trader status. Say we're not going to ever jam you with a bunch of day trades. We're going to, if we have a couple day trades, we're going to back off a little bit and for a couple days and then come right back at it with more opportunity. The beauty of this is that booking that double we found was a really good technique. Where early on we used to let things run. We even had 169% gain in Amazon. We're like, yeah, this is great. Just let it run until where the ADX finally rolls over and then get out. Well, you can see in this example, by the time ADX rolls over, you've given back most of your profits by the time it's flipping the other direction. The green line rolls back down. You're going to see that our methods that we've adapted to allow you to kind of book profits once you get to a critical threshold or trail your stop point to where you're still protecting the bulk of your profits. These are critical techniques that will help you to stay with the good trends, but get rid of the ones that start to get a little noisy and start to give back more than they should. You can see in this example, it's not all gainers. We made about 46.98%, then almost 50% on puts on Netflix a couple times, and then we lost a few percent where it should have fired. It was starting to make money, and then bam, it knocked us out the next morning, and we're getting out about where we got in and losing a little bit because of that time loss. Time's so important to all of us, but especially important when you trade options, that you've got to make sure you're catching the sweet spot of a move. And you can see on this chart that you're really focused on those quick and meaningful, steady trends and zeroing in accordingly. I'm kind of curious if you want to type in one of these numbers, 1 through 5, to tell me what type of a trader you are. Would you say you're more of a day to quick trader, 1 to 2 days, swing trader, 3 to 5 days, hit the number 2, position trader, number 3, 1 to 4 weeks, up to a month holding period, or even active investor, 1 to 12 months, or if you just buy and hold, 5, passive investor? We get mostly proactive folks in here, but and some people would say they're a combination, like Paul mentions 1 and 2. Izzy 1 or 4 and 5, Scott 2 and 3. So we got a mix, but we got quite a few in the quick trade camp to swing trade camp, and that's great because that's really the focus point that I'm really kind of zeroing in on is like I said, 2 to 3 days, kind of in between like a stretched out day trade or a quick swing trade is really what I'm looking for. And you're going to see in these examples that what I do is I zero in on a 30-minute chart. What I mentioned at the beginning is you could apply this to any given strategy you want to use, then just adjust your time frame. If you wanted a purely swing trade over about a week, I'd probably move from a 30-minute to a 60-minute. If you wanted to move to a position trade, I'd probably move and focus on the daily chart with what I'm going to teach you today on this ADX strategy. Active investor, probably weekly chart, passive investor, probably monthly chart. So there's something in here for everybody, no matter what type of trader you are or investor. I use a lot of platforms, TradeStation, Thinkorswim, Metastock, and more. And what I'm mainly focusing on here is TradeStation. So that's the one where I originally coded all my stuff in the early 90s. And again, early 90s, when I got into trading, 1990, I'd graduated from Duke University, thought I knew it all, thought we all know we're brilliant analysts, right? We all know how to do great homework, and we know how to put a position on, and then all of a sudden the market doesn't validate what our analysis suggested. And we're like, well, the market will eventually catch up to what we know, right? Not such a good idea to not listen to the market. So I quickly adapted to technical analysis to really focus on going with the flow, getting in tune with what the market's giving you. And when it's not giving you what you thought, getting out and moving on. So all these indicators are based on that. Trade what you see, not what you believe, not what you hear from somebody else. So what we're focused on our key indicators here, the directional movement lines set up to show you how the ADX is starting to show a trend in the market based on Wilder's average true range indicator. We'll give you a little overview on what those mean a little bit more. But this creates a trade funnel, which really makes me selective. What's a funnel? You think, well, a funnel means that you're narrowing down your opportunities. Some people would say, I just want to trade like all the time. I want to be in the game all the time. That's not how to win the trading game. My grandfather was a very prominent thoroughbred horseman, helped really found a racetrack during the Depression years called Keeneland here in Kentucky that's become kind of an institution in the thoroughbred business. And he used to say, you can beat a race, but you can't beat the races. And it's kind of the same way. If you try to trade every single thing that you see, you're probably not going to have great results. If you're selective, you're probably going to be a lot better at really becoming a master at one pattern rather than trying to do 18 different things. It's a pretty good rule for life, but especially for trading. And so the beauty of this is that what we're focused on is showing me the directional movement, Wilder's definition for you making net new highs and not making new lows or in an uptrend or vice versa for a downtrend. Wilder's first he had a ton of contributions. It's the same guy who invented the RSI indicator that everybody's familiar with. But he said, you know what? A lot of people look at the range for the day as the high-low range. So if you look at a given bar, you say, well, it opened and then it closed, and basically the high-low is the daily range. Well, and then the next day, say we open up here and then we close about in the middle of that range and say, okay, we got a couple of medium-sized ranges there. What Wilder said is, hold on, you're missing the gap. Whereas most people would call this the high-low range, we'll call it R. What Wilder said is, you know what, when you factor in the gap, if you go do a dotted line from where we closed that prior day, your true range is actually from that day, next day's high down to the prior day's close. So that'd be the TR, the true range. So what the true range can only do is it can only expand your ability to pick up how much real total price action and movement you're getting in a trend compared to just people that were looking at the day-to-day ranges back in the day. So true range can only be the same or higher. It can't be lower than the day's high-low range. So it basically shows you the real true total movement that you're getting, and the directional movement lines show you the net new movement you're getting in the form of higher highs in an uptrend for a positive directional movement rising, or if you're getting higher lows, that's going to show you the negative directional movement's going down. The amount of new lows is going down. So DMI minus is like new lows, DMI plus new highs. We'll go into the charts here and show you more examples of that. But ADX is where you see the configuration typically where when ADX starts to rise, it's because one of these DMI lines, say we're making new highs, the DMI plus is going up, and we're not making new lows, the DMI minus is going down. When both of those are going in opposite directions, starting to pull away from each other, that's when it's going to typically allow ADX, the average directional movement, to start picking up and gaining. And that shows you that you're in a trend. Now, the original criticism of the green ADX line on the bottom here was that people said, well, if you just plot the green line by itself, it shows you that it's trending, but it doesn't show you what direction. We quickly fix that by showing you that the DMI plus is in blue, the DMI minus is in red, like we said, the ADX is in green. And so we've got a positive trend shaping up here. This was Amazon the day after the midterm elections results. The market had been not doing so hot before the elections, but then you saw what happened. We got the big gap up. And one of the things we also add in here is we add in a moving average filter, the black line here. And what you'll notice is that this moving average filter, when it closed that first half hour after the market's gapped up and it kept going on Amazon, we closed above that moving average. That now grades as a positive, that the filter, it's showing us an upward trend starting off, because we want to just catch it right as that ADX crosses above that declining directional movement, in this case, the negative directional movement in red. So it actually has to be pulling apart enough so that spread between those shows you that now we're really getting a strong trend. Now, we're really picky about our trailing stops. We were up some 75 or 80%, boom, in an hour. Okay, you say, how's that possible? Well, with Amazon, we've got to be a little more aggressive. With Amazon and Google, we can pay up to $15 for an option contract. That's $1,500 to control 100 shares worth of stock. Obviously, 100 shares worth of stock with Amazon was trading over 1,700. That's, if you buy an Amazon 100 shares worth of stock, you want to pay 170 grand to control that 100 shares, or do you want to pay $1,500? That's where the 100-to-1 type of leverage potentials exist with this strategy, because you'd see such tremendous quick opportunities. Now, the reality is I'd prefer to buy them in the money below that 1,700 area where we got the signal, but we had to buy 1,760 calls. It's out of the money options. It's because Amazon's gone up so much, but we don't want to miss out because it's been a massive leader in both directions, but mainly to the upside. And so the reality here is that, okay, so the examples I showed you earlier about our gains were based on mostly $1,000 invested per trade, but with Amazon and Google, we can now go up to $1,500 as of the start of this year to say we don't want to miss out on those key FANG opportunities and have to buy way far out of the money if we're only investing $1,000 or less into a given options contract. And you can see with a lot of these, if we buy them for more than $5, we're only putting 1,000 to 1,500 in. We're only going to be able to get one contract. I don't need to in our model portfolio. You could do more if you're trading larger, but I always encourage people that are starting out to start small and then you can scale up. The beauty of investments is any strategy that you show works, you can keep scaling into, especially ones like this that are so active and liquid, where we're just a tiny fraction of a percentile of the marketplace when we make these trades. So the beauty is, okay, we know we've got liquidity, we get in, we're up, and then we put a trailing stop in. Once we're up at least 30% on a position, we start trailing our stop to 30 percentage points from the peak. So if we're up plus 30, we'll move our trailing stop to break even. And we give you an initial stop too. It's kind of what we call a disaster stop, to just protect if something wacky happens in the market intraday, to protect you from just a total wipeout kind of scenario. We don't want that, obviously. The biggest risk with this or any strategy in this current market is the overnight gap risk. So, yes, sometimes we do take the profit the same day when it hits our trailing stop or our initial stop or our 100% target. This one actually would have gone on, you see, by the close of that day on the 7th to 100%. But I don't mind still taking 43% and saying, you know what, risk management comes first. When it rolled over on this particular bar here, it gave back 30 percentage points and knocked us out of the trade. And ADX was still going up. One of the beauties of ADX is it's very, very steady in a good trend. When it's no longer steady, then you shouldn't mess around. You can see technically when ADX rolled over on this big spike bar off the next bar's open right here on that spike low, it's telling you to exit at that bar's close, and that was right near the peak. If you're just following ADX purely, you would have made more money on that example. But there's a lot of examples I'll show you where our trailing stops actually protected more of our profits and saved us from a big reversal. One of the other things I love about this methodology, now we got a black background here, so we kind of go back and forth here. Love to get your feedback if you like the white background or the black background better. One of the things, though, is that you see, okay, Google has been really dead money for several days, and the stock was going nowhere. And you know how it is. When you're trading and you're watching something that's like watching paint dry, it's very tempting to want to give up on it. But what we say is that about the time that everybody's giving up on it, we're getting our signal to buy right into that bar's close right there. And interestingly, it's coming right into that close where we're kind of back into those old highs around 1140 on Google. And thanks for the feedback, Bill and Sandra. I'm preferring the white background. We'll keep that in mind in the future. Bottom line is that, you know, a lot of people say, oh, wait until it clearly breaks out above that old high there, that intraday high there. If you wait for the close of that bar, what happened here? You've basically missed half the move. At 1140, now that buys up at 1150, and our exit's at 1160. Our exit's happening. We get that little rollover there on the ADX, 1160-ish, we're out. Now, you know, we don't want to give up half of the potential in a move. So one of the nice things about this is that it shows you when the market structure, the price structure for these FANG stocks is starting to change in your favor for a trend. It basically gives you an early signal to get on board before everybody else who's just chasing price action alone. I know a lot of traders who say, I don't look at indicators, I just look at price action. And I tell those traders, well, let me give you a neck brace because you're going to need it for all the whipsaws that you get and all the missed opportunity that you have just looking at just price. If I can find an indicator that gives me a little bit of a lead against the price action, like an ADX, starts, even though I'm not going to catch the exact tops and bottoms, I'm going to catch what I call the sweet spot of the move. That's what I want. That's where you're going to have confidence in your trades because you know you're trading what is really moving into a nice kind of a zoned in move. In this case, a downside move. Obviously, we got the below the moving average up top here. You can see that we've got the negative directional movement above the positive directional movement in blue, and we're getting that green ADX cross. And again, we're not early. You can see we're in the neighborhood of about 10.25 or so on Google, and we're buying out of the money $9.94 plus your condition on the way out. And then the next morning, we're actually taking our profits to 60%. Just because we just wanted to grab 60%? No, it got to almost 90%, and then it started to flip up on this bar here. So when you see that you're starting to lose that price movement in your favor from a trailing stop perspective, then it tends to serve you well to say, okay, we're getting out kind of in this zone right here. Notice when the ADX rolled over here, we would have gotten out a lot worse and given up the bulk of our profit. So it's really important that you have this kind of proactivity. So a couple of you say my audio is breaking up. Not sure what's happening there, but might be the great crowd we have in there. But basically, and I'll remind you of some dates there, Sandra, as we go. Sure thing. You know, but bottom line is that, you know, when I started this approach, I used to be able to I could only focus on in-the-money options, even with the Amazons and Googles, because they were a lot lower price. But what's happened is with Amazon and Google, and even Netflix to an extent, we've had to go closer to the money, or in some cases with those $1,000 plus stocks, out of the money and be really careful about controlling risk. But the beauty of the in-the-money options idea is you can still do it with Apple, Facebook. You know, that when you're focused on this, you're saying, you know what, you have an opportunity here to really why buy the house when you can rent it? You know, if you know you're only going to be in town for a week, you don't want to buy that house just to come in 1 week a year when you could just rent it for one out of those 52 weeks, right? And the beauty of this, too, is that you don't have so much capital tied up in these positions, so you can really take advantage of these opportunities with a lot greater confidence. You know, I mean, to me, that's what this whole trading game is about, is building your confidence and zeroing in on only being around when you really want that leverage. Because let's face it, leverage is an attractive word, but it's a double-edged sword. It can also cause you a lot of problems. When you and the reality of everything we're talking about, the FANG stocks, and why I like using leverage on them is I like them because I use it when I want the leverage. When I don't want the leverage, or I'm not even sure about are we going to still trend on a trade, I'm out. I'm done. Don't ever be in a position that you don't have the clarity and the confidence that you should be in that position still. So it doesn't matter where you bought it. It matters what's happening in the now moment. And so that's really important, because a lot of people get stuck in the concept of saying, oh, I bought it, I'm still profitable. It's going against me, but I'm still profitable. I was talking to somebody that was in Bitcoin that had made a ton of money in Bitcoin, and if they'd cashed it out when I recommended at the start of the year, they would have turned 50,000 into 7 million. Now it's under 1 million. Is what not a bad problem to have. They're still like, well, I'm still up a lot. It's like, well, you still left 80% of your profit on the table. That's not acceptable to me. Just from a pure just how to follow the trend approach. So the beauty of this is that, okay, 100 shares of Google costs you over $100,000. One call in there for no more than $1,500 gets you leverage potential in this example of 70 to 1. And so you can see, and we've got some that don't have the chart, that don't have the dates on here, but this was in Netflix earlier this year, was in an uptrend mode. It's actually been in more of a downtrend mode. I've got some Netflix charts. I think I showed you one already, but more to show you on Netflix. But this is an example where by the time we get the signal, it actually is above those recent short-term highs earlier this year. And so now you're in kind of clear upside breakout mode. But the beauty of this is that sometimes, you ever notice on a breakout, you say, oh, I've missed it because I'm late. I should have been buying a lot earlier. You come up with all these rationalizations why you shouldn't participate. Anybody ever do that? Anybody ever question a breakout and say, I just think I've missed it. I think it's too strong. I think it's gone too far. It'll probably reverse right as soon as I get into the trade. Yeah, I'm raising both hands. We all have done that to ourselves. The beauty of having all the time, says Bill, I can relate. The beauty of having a clear system that tells you exactly if the edge is on your side is you don't have that second guessing anymore. You just follow the system. Does that mean that every trade's going to win? Of course not. There's going to be trades that fake us out. But I know that over time, the edge is going to play out. We're playing a probability game here. We're not playing for 100% guarantees on any trade. But what we're saying is that we know we have an edge at that bar's close. And yes, it feels like we're late, but we're getting in anyway. And we're saying, look, we're buying a 307.5 call. We paid $700 for it. We're just getting one of those on our model portfolio, and we're turning that $700 into more than $1,500 the next day. A nice quick $800 profit. And you can see in this case, when we made it, we're saying on the gap up, if we target 100%, if we get gaps in our favor, we say, fine, we'll take the windfall, thank you. But bottom line is that that's what we want to focus on. Here's an example coming back on Amazon also from basically last year, because it was so much lower. You can see $1,300 that essentially you can see here again. Looks like you're late. Looks like, oh, well, gee, it was just at 1,300. Now you're telling me to buy and it's 1,320. Well, that's a pittance for Amazon, 1.5%. You can see it's on its way the next day to going up another percent to 1.5%, right? And then so 1.5%, if you make 64%, you can see your leverage potential here is 40 to 1 plus. And so the beauty of this is that, yes, we had to buy more out of the money than we're probably accustomed to. I think there was an earnings report coming up. We weren't going to ever hold these into an earnings report. Never, ever do that with this strategy. We're just trying to take advantage of the trend. We're not trying to play gaps on earnings. Daniel mentions he's been burned by breakouts. I understand that. And the beauty of this is, and I teach other methods too about how to get in on retracements, but this method is about momentum. The reality is when the FANG names have, not just when they moved up, but in the last couple of months when they moved down, we've been pounding them on the downside. And that's where all of our profits are. And that's where the only profits have been for the most part. I mean, yes, you get the occasional bounce in Apple or whatever. Then the next day, like yesterday, it gets pounded back down $5. So the reality is you've got to be able to trade both sides here. And we said, okay, you know what? Because it was flipping off of that prior high right off the gap, that hit our trailing profit protection stop up 64.8%. Start of the year, Sandy, this is the first trading day of 2018. You can see January 2nd. And you can see what happened here. Facebook started to rally. Actually, I have my big trends bands plotted on here. The light blue line's the upper big trends band, which shows you another form of breakout that I teach my big trends students. But I'm really just focused on this ADX cross right here. 4 bars in. Gee, you feel like you're late there, don't you? $181. Well, here's a great case where we can buy the January weekly 175 straight call. The stock's about 181. That's worth $6 intrinsically. We only paid $635 for it. That means that just over 5% of our total premium, 35 cents out of the 635, or about 5% of that total option value is time value. That means if nothing happens, it stays stuck at 181, you lose 5%. Sure, if it goes against you, the stock drops below 181, you can lose more. But the beauty of this is that you don't worry about if it flattens out on you, that you're going to get killed by time erosion. That's what a lot of people are worried about when they say, oh, weekly options, that'll clean your clock. Well, if you trade them wrongly and trade them excessively aggressively, yes, you can have problems. So we don't need that massive leverage. We already get it, but we don't need to go for ultra maximum leverage. You can see that it goes here from 181. By the time we get the reversal in the ADX, 2 days later, stock's just under 185. So you made about a 2% move in Facebook, and the options up 57.6%, like 19 to 1. Or I'm sorry, 29 to 1, excuse me, 29 to 1. So bottom line is that almost 30 to 1 leverage for, the time you wanted it. Now, was there another run up? Yes, it ran a little more. You say, oh, ADX turned up again right in here. Should you trade that one when ADX turns up on any old ADX turn? Absolutely not. It's not low enough. It needs to be down here on ADX and crossing up, and it's not doing that. So you say, no, thank you, and you can see what happens. If you're holding and hoping, maybe you're not getting hurt for those next couple of days, and then you walk in one morning and bam, downside gap would erode all of your profits and turn it into a big loser if you bought off of that last ADX turn. Even off of the original ADX turn, if you held that long, you've lost now a week and a half of time, and that's going to hurt you. You can't afford to do that. So you got to be nimble with a strategy. We give you specific entries and specific exits. We never leave you hanging with this strategy here, or any of our big trend strategies. We're not using a spread VC. We're just going directional, straight call, straight put. And if that concerns you, what I always tell people is, look, we're not putting in more than $1,000 to $1,500 a trade. If that's too much for you, then yeah, you probably ought to go elsewhere. But I'm saying, look, if you can just put small allocations in, you can say, look, just let the results take care of themselves over a series of trades. And we're never loading the boat. We will never hold more than 2 FANG positions open at any one time. So you can actually get started with this with even a few $1,000 if you wanted to. So so the beauty of weekly options, if you were looking at like last month, we had like the 5 Fridays of November. Every single Friday here was a weekly expiration. Now, we're not going to trade them the day before they expire. That's too risky. But, usually we've got about at least 3 days left before expiration. Like on a Tuesday, we might look at that Friday's expiration, but by Wednesday, we're going to stretch out to the following Friday weekly option expiration. So we're going to give ourselves in the neighborhood of between typically about 4 to, up to maybe 8 or 9 trading days before expiration. You say, gee, that sounds aggressive. Everybody tells you in the traditional options trainings, don't buy options less than a month in time, because they know that most people just blow themselves up without any proper risk management. But if you follow our entries and exits, you know that you're going to be able to hit it for the time you want leverage. When we don't want the leverage, you're going to get clarity about where we're recommending to get out, whether it's a profit or hitting a stop. So, and the beauty of this is that, of course, events are catalysts. I never trade in front of events, but I'm looking for the response after an event. So when we come into an event and then the event's a bullish event and we get the proper upside catalyst, sure, I love to get that fundamental opportunity to ride a piece of that response as the institutions start to shift money into something that's got a positive earnings surprise, or something like Apple had this negative earnings surprise and it's been down, down, down ever since early November. Speaking of Apple, this is one going back into the prior year, October 27, just to show you just numerous examples. We've got tons of current ones too. This is one where it didn't happen on the first bar, but the second bar in, it keeps going up and ADX crosses up. So on the close of that bar, you say, where's Apple trading? Apple's trading right here about in the neighborhood of about 160 and a half. So we're buying a 155 call. We're paying $7 for it. It's worth about $5.50 intrinsically. If you're new to options, a right to buy a 155 is what you're buying. So it's already at 160 and a half. For $5.50, you're paying $7. Why would we pay that extra $1.50 of time? Because we're saying, look, that's still barely over 20% of the total option as time risk. Almost 80% of this option is intrinsic value. And what I love about this is, notice, when Apple flattens out later in that day after we're in, we've made some money already, but then it flattens out. How many times you see something start to create a flag pattern, or you say, uh-oh, maybe that's a double top at the end of the day, you start second guessing yourself. I say follow the ADX. You know, as long as it doesn't hit our trailing stop, ADX, the green line, keeps rising. Some people even tell me, oh, well, I'll get out when the DMI line crosses underneath the ADX. Well, in this case, that wouldn't be much of a difference from the slight ADX bend there, but a lot of times it'll cost you, you'll still get out too early versus an ADX turn. And then the final ADX turn, of course, happens a couple days later, and then it kind of flattens out for a while into November. But, you know, the beauty of that is that we're able to create great leverage with those moves. Here's a one with Apple where we made that 102% in just a few days. When it went from 147.5, we bought a 142 call. You can see people are going to lose interest when the ADX has been going down here. The green line's going down. Everybody's like, yawn, it's a trading range. I can sell premium all day in that environment, make money. A big mistake to be getting caught selling, say, call credit spreads, and then the stock blasts off and you're on the wrong side of a big trend move over the next few days. You can really get your head handed to you if you get stuck in the wrong kind of trading strategy when the structure changes to a strong trending market. So again, it flattened out that first day we're in after making some moves, and a lot of people give up on that trade and say, I better get out before the end of the day. And then they leave a ton of opportunity on the table as it goes from about a 30% gain the first day to a double just the morning after the next one. So 3 total days held. Now, I want to talk about high dollar stocks in the options pricing model because this has really been where I've gotten tremendous bang for my buck. All these FANG stocks, as you know, are well over $100 a share between Facebook and Apple in the 150 to 200 range versus Netflix in the 300s. And of course, Google and Amazon over $1,000 a share. So they're high dollar. If each of these stocks rises 5%, we've got a green stock that's going to go from 20 to 21 in 5 days. That's a nice move, right? The $200 stock in orange is going to go from 200 to 210, another 5% move. Those should be equivalent, you would think. Not just, as a stock owner, they are, but as an options owner, you would think, wouldn't they be equivalent for the same kind of option? We buy about 2.5% of the money by 19.5 call versus a 195 call. You see just a factor of 10 here. But the options pricing model uses the same volatility assumptions, and then all of a sudden it's like, hold on, we're paying $1 for the $20 stock, and we're paying $5.50 for the $200 stocks call. And you say, okay, well, if you look at how that buck on that 19.5 call plays out, half of that's intrinsic value, and the other half is therefore time or extrinsic value. On the other one, you see we're getting a $5.50 option, and it's got 5 of those dollars from 195 to 200 is intrinsic. Only 50 cents thus is time. And so again, we're like 90% intrinsic, 10% time. 550 times 2 gets you $1,100 to get 2 contracts. So I said, well, let's match it up over here, $1,100 to get you 11 contracts. A lot of people love the thought of getting more contracts. More contracts is irrelevant to your maximum profitability. What we care about is the proper leverage. If we catch that quick move on the $20 stock, yes, at 21, the 19.5 calls were the $1.50. You paid $1 for it. You made 50% on your money. But then you look back and you say, well, hold on, what's the 195 call worth at 210? It's worth $15. We got 2 contracts. That's $3,000, and we put in $1,100. We made $1,900. That's 173%. The caution I would say, because a lot of people don't even believe this, but the caution I would say is that yes, this is the case, but it also is a double-edged sword. If you're wrong, and you can get 3-to-1 leverage against you if you're wrong and you don't cut your loss promptly and quickly. So it's just saying that's why I say catch the leverage when you want it. When you don't, get the heck out. So case of Amazon, this is one where we did get out the same day because we were concerned about the way things were acting into the close. We would have been stopped out that next morning, so it worked out to get out. Our trailing stop would have kicked in and been about half of this 50% profit. But essentially, you can see here that on the ADX alone, it went on to an even bigger gain. That happens sometimes. At that point, you say, well, should I trade it the other way? This one came back down some. And I say, no way. You should not mess with it. We're still above the moving average. The DMI lines are still net positive. They're just basically going through what I would call a volatility contraction as ADX comes down, as those DMI lines squeeze down into each other, the blue and the red lines squeezing down to each other is what's pulling that ADX down. So you want to trade during that volatility and range expansion when the ADX is going up. You don't want to mess with it once ADX peaks and rolls over. Just stay on the sidelines, wait for the next one. Here's an extreme example where we got into Netflix right off of the first half-hour close, 10 a.m. Wall Street time, right on that ADX cross there. And we had to endure it almost stopping us out. It didn't quite get there, about a minus 30% stop. It's down about 28%, and then we were able to say just go boom. You say, well, didn't the ADX roll over when that thing's going down? You see it slowed down, but it did not roll over, did not go down. And so you see a couple days later when it did, that Netflix call exit up 48.9%. So it shows you, it gives you staying power when the trend is still your friend. When the trend is not your friend, it tells you get out, move on, forget about it, okay? So another Facebook example here, you can see we love those in the monies where you see this is giving a signal here at like 128, 127 and a half, call it 124 call. It's worth about $3.50. You pay $3.90. That's a 90-10 ratio, 90% intrinsic. What that means is at 10% risk, if it does nothing, I'll take that all the time with the kind of leverage we're able to get, because we know, sure, if the stock's flat, you lose nothing on the stock, but you lose a little bit on the option, but that's just basically the cost of doing the business to get this kind of leverage. Where the stock goes up from 127 and a half, and by the time we get an exit, it's about 130 and a half, up about $3, or call it somewhere in the neighborhood of about 2.5%, and we're getting 74.3%. So we're getting, this 25 to 1, actually almost, again, 30 to 1 actually leverage on that one too. So it's just tremendous. And you see, of course, then that one did come down too. The ADX turned up, the DMI lines went negative, but you would not have taken that trade because you're above the moving average filter. And so it keeps you out of trouble as it pops back up off of that. So it's all about risk management. What we do is we fire out these real-time email and text alerts to your smartphone to help you take advantage of these signals when we get a new entry or a new exit. And so that'll allow you to be more proactive. More case studies to show you. Sometimes these signals come in right near the close. Do you think that anybody might know something when Google rallies that fast and furious in the last hour and a half of a trading day after actually being down in the day, it comes back to positive right in the final 90 minutes of the session? Do you think anybody in the institutional crowd might maybe get wind of maybe an upgrade or something that might be coming down the line? No, it couldn't be, right? I always assume that somebody knows in the institutional crowd a lot more than I do about where these stocks are headed in the short term. All that I'm trying to do is catch a piece of the action for our subscribers. And so when we get that upturn right there, and so we see it happening with about 15 minutes to go, we can still fire out a trade to say it still gives you time to take advantage of it. If you're afraid of missing trades with a tight window of entry near the close, make sure that you look into auto trading. It's something you can do at no additional cost to what your broker would charge you if you were placing the trade yourself on certain platforms. You can ask Chris Sarah, my lead consultant, about that at our 800 Big Trends number anytime. But bottom line is that, from this perspective, you see, where does this thing peak out? When ADX rolls over. Interestingly, it rolled over when you had an up bar. A lot of times, most indicators that are stops will get you out kind of at the worst as it breaks down below moving average, breaks down below a trailing stop level. But sometimes, just because we're not following price action by itself, we're following the structure of the ADX. Sometimes you get some really nice exits on retracement bounces. Turned out this one was right near a key short-term top. So, 88% in a couple of days because we're in the day before. So I believe that that gap, we all have gap risk on every trade we do, but I believe that gap is in our favor more often than not if we pick up a signal that's happening right into the close. From our experience, that typically, it doesn't guarantee it, but it typically makes you more confident. Plus, you're assured you're not going to have a day trade because you're getting in near the close, you're getting out at earliest the next trading day. So the whole approach here, most people would say you've got to focus on volatility. It's the thing you don't know in the options pricing model. I would say that the thing that the options pricing model misses is that it assumes there are no trends. And if you can find high trends, you're going to find undervalued calls and big uptrends and undervalued puts and big downtrends. So we focus on finding these stronger trends, using in the money options where we can, or if we have to use those more aggressive options with the Amazons and Googles of the world, we will just trade them a little closer to the vest and really make sure that profit protection stop is in place. Another quick example on Google here, you can see starting to break down right off of an open there, October 18th. And you can see that the stock's just under 1120, called 1115. We're buying a 1062.5 put, about 50 points out of the money, 5% out of the money. Stock goes down here to under 1100, down a couple percent. But then by the time it hits back into our trailing stop, even before the ADX rolls over, which happened on the next gap up, which by the way saved us, made 30% versus probably a slight loss the next morning. We said, look, it's our profit protection. We're giving back too much in this evolving downtrend, and so therefore we just take the profit and move on. So it's kind of an exit first and ask questions later approach when it comes to something that gives back too much of its maximum gain in our experience. What we do is we call out real-time trades. I've got an older one here so you don't get it confused. I don't want you placing a trade off of this. We'll call out, though, real-time email and real-time text alert to tell you to buy to open a certain option. This is one of the first times when Amazon crossed $1,000 that I was recommending calls in the middle of 2017 going, man, I can't believe it's $1,000. Who would have known it would have gone to 2,000? I'm not in that game on this strategy of trying to predict where the stock is going to go by the end of the next year. I want to know where the odds are that it's going to go by the end of the next day or 2 or 3, so that when we have that edge, we can take advantage of it. When that edge is gone, we get out. So we'll tell you where to get in. We'll also always tell you where to get out. This is our best trade. And again, now these days, if it hit 100%, we would book it at plus 100. So don't expect that you're going to get more than plus 100. Sometimes on a gap you will. But bottom line is that you can see here when Amazon was still below $1,000 last year, early March, it was just on one of those nice runs. And you can see this is one where it might concern you where you're like, oh, well, it's kind of having trouble into that old high. We're getting our signal below the old high that earlier that day. And I'm saying, you know what? The market structure is telling us this is ready to go. A lot of people be worried into the close there that it's backing off. And then, yeah, ADX flattens out, but it does not roll over, does not go down. If it goes down at all, that's where we got an exit signal. And it happened there a couple days later after our attempted rally that failed. And we're done. It ended up that Amazon went a lot higher, of course. And that's why I always tell people don't try to short these. Some of the keys to successful FANG options trading, I believe that catalysts are important. So when you get earnings catalysts, I think that's important. Certainly the technical breakouts and momentum shifts are important as well. When you're able to buy them in the money where you can on the Apples and Facebooks, that gives you what we call a higher delta. That means you're basically getting more bang for your buck on each point move in the stock. But of course, how fast each point move can add up on Facebook and Google and Amazon, all these higher dollar ones, Netflix, that you can really see that even medium to low delta give you so great bang for your buck. When the ADX turns, we're out. Or if the profit protection stop gets reached, once we have a gain of 30% or more, we start that trailing profit protection. And then we ride until the ADX rolls over until we get a double of 100% or hit that trailing profit protection. So it's really simple. And then I give you regular training updates. So this isn't just a black box. All subscribers get all the settings for the ADX, the DMI lines, the moving average, et cetera. And we're constantly open position updating. We always follow the big 5 names along the way. As I mentioned, Netflix in October this year, those 3 examples. What I love about this is it shows you that, A, you would never want to try to buy Netflix on a dip during this decline. A lot of people get seduced into thinking, oh, there's got a retracement rally here. I should get a piece of that. No way. You should just be staying on the sidelines after our exit until we get our next signal. Now, in any given downtrend, you'll notice that, sure, this one gave up some ground from our peak profit by the time it reversed into the ADX turn now in yellow on this black background. But bottom line is that you'll notice that the next signal here is happening at a lower level. That should be happening in a downtrend. The following signal that we took happening at a lower level. That following one, of course, after the 2 that worked, the next one didn't, because you see it was starting to work and then starts to flip up intraday the next morning, and that's back closer where we got in, and that's giving us a small loss because of that slight time erosion and an out of the money put. So again, being very close to the vest, saying, okay, and when we get a new signal, I think we actually had one that we think could be a new signal for Monday morning. So when you take advantage of that, you'll be ready to get the new trade alerts come Monday when you sign up, and you can start to get the member site access to review past trades and really start to understand the system as you get ready for trading this next week and beyond into 2019. And what I'm going to share with you actually can take you all the way through 2020 as well. As I mentioned, if you came in late, not every month is up. Some months are down on their total. This is putting $1,000 a trade in, or this year started $1,500 on Google and Amazon a trade, just to make sure we could participate with a proper option. You can see that over time, it's been in a nice equity curve. It doesn't guarantee the future. There's going to be drawdowns along the way. But that's why I say start small and build. I'm confident that we can really show you just how well you can do with this. Again, another great example here with Facebook back in May, where you saw that it was giving a setup here, and it was below the recent highs. You see that happen, and a lot of people get get worried again, try to buy it once it breaks out up here somewhere. And I'm like, again, you've left about a third of your profit on the table. This one kind of consolidated a little bit, but the ADX, while it flattened out, did not roll over, just kind of gradually edged up bar by bar. So ADX is much more stable than a lot of other methodologies that are going to kind of whipsaw you in and out too much. I want something that's going to just give me kind of the sweet spot of the trend. Obviously, it's a phenomenal move into a couple days later on the 10th getting out. At that point, it's anybody's guess. Sometimes after we get out, it then keeps going up and you kind of kick yourself going, oh, I wish I'd stayed in. And then it drops back down. And you're going, God, I'm glad I'm out. So if you've ever had that kind of manic depressive feeling in the markets, this will help smooth out that feeling dramatically. And as I said when we started, now that you know how the ADX works and the DMI lines work, you can see that first example I showed you to start off that happened there back right before Thanksgiving. You can see we got into the Netflix 267.5 puts. It wasn't that out of the money with the stock trading here about 275, and then boom, it pops down to almost 250. Stock's down, a nice quick, what is that, 8% or so, and you say, you know what, well, thank you very much, we'll take the 100+% coming off of the open, and glad we did as it reversed back up. You can't predict given bars of price action, but what you can do is say, okay, when it hits certain targets or hits certain stop levels, you can control your behavior about how you follow these rules. If you follow the rules, I have a lot of confidence that you're going to see success over time. And like I said, 2018 has been an even better year for us than 2017. That surprises a lot of people because I know a lot of you have told me how challenging this year's been for you. You can see October and November very positive for us. And again, there's going to be losing months. We expect our winning months to average about twice the size of our losing months. And what I want to share with you, since I've got a few minutes left before I hand it back over to Jeanette here at the top of the hour, I want to share with you a special that I just gave to my Big Trends community that actually I'm going to pass along to the TradeThirsty crowd here today as well, which is kind of insane value. I launched Big Trends in '99. We're coming up on our 20th year anniversary this coming year, and I feel like we've been around this long because we don't just give quality of education and quality of what we put out there to you, but we give you great value. So when you think about, most places would charge you easily, and on our website you would pay $19.95 a year for this if you just bought it straight off the web. And I did a special where I gave my subscribers a year for just $595. But I said, I've spent a good year. I'm in a generous mood here. I said, you know what I'm going to do also here as we head into the holidays, I'm going to give you a holiday BOGO special, which means you buy the first year. I'm going to give you a second year on me. I call it my instant double on your subscription time if you act quickly. And so basically saying, okay, I can't keep this out forever, but bottom line is that you can see here that you're getting 24 months access. That means over the next 2 years, you're going to get 200 trades from me on FANG options, bull and bear opportunities for under $600. That's less than $3 a trade if you break it down that way. But you've got to buy the full year package and get the BOGO. You get the 2 years for about, what is that, 70% off or more off of what you would pay on our website. And you can still knock it down on the 3-month access from $295 down to $199. So I'll show you that page here in a second. And you get the same quality of what we do over the next 90 days, but of course you don't get the same value in terms of, it's still a good value, obviously less than $10 a trade, but it's not less than $3 a trade like the BOGO 2 years for well under the price of one is. When you go to bigtrends.com/FANG, that's where you need to go. We try to make it simple in how you need to follow this and be prepared to take advantage of it here. So let me actually show you here real quick. Find my FANG page here real quick for you. There it is. Let's pop it up and show you what you need to do. So when you go to this special link, we've already adjusted it for you. There's no coupons needed. All you have to do is hit the orange add to cart button, and you're getting 12 months for $595, and I'm throwing another 12 months on top of that at no additional cost. So this is a one-time investment. It will not auto bill after 2 years. It's basically just $595. You get 2 years of FANG options trader. You can see the loads of great trades we've had in recent weeks and months. And bottom line is that you also get a lot of other benefits here. You get the training, you get the access to me and my team. If you have questions about it, you don't understand the methodology, we'll give you all the details about the methodology, including all the settings, everything you need to do to follow along at home. And then there is auto trading available, and this is no charge from us. It's basically you just pay the broker what you'd pay them anyway if you were doing the trades on their platform, but they help you to pull the trigger to get in and out when we send our alerts over. We don't know anything about your account. We just send the alerts to these other auto brokers, and if you set up with one of those, once they confirm that you're a paid subscriber with us, you can then take advantage of that without having to monitor the markets intraday at all or worry that you're going to miss out on anything. So from that perspective, it's tremendous. You can see it when you add it to the cart. One thing I want to point out to you for the text alerts is that, yes, we assume you would like to have 2 years rather than one for the same $595 investment. And you just hit the green checkout or the PayPal checkout. When you hit your checkout options, when you scroll down, everything in bold you need to fill out so we can make sure you're getting you the emails. And then once you do your PayPal or whatever credit card you want to use, I want to make sure if you want to get it to your smartphone, which I highly recommend for the text alerts, because if Chris has helped you today, you can click on that, you click on a webinar, me, whatever, and basically say, text the alerts to whatever your cell phone number is, okay? And what we ask is once you type in your cell phone number, then we ask that you tell us what provider it is, whether it's AT&T, whether it's Verizon, whether it's Sprint, you name it. Basically, just type that in because we put them on separate batch lists. Everything goes out at the same time, but basically that way nothing ever gets hung up if one provider would be out for any reason or something. So basically, all you do is read the terms and conditions here. It's clearly spelled out to you how this works. Click on the checkbox once you've read that and hit your submit order button when you've got your key information in. If you have questions, you can call us toll free at the top right of that page is our toll free 800 number, and it's easy to remember. It's just 1-800-BIG-TRENDS, 800-244-8736. Just remember 800-BIG-TRENDS, or you can email us anytime through clientcare@bigtrends.com. It's my way of saying happy holidays to you to get such an immense savings off of 2 years of value, almost $4,000 of value for just $595. That works out to, I guess, more like 85% off. Happy holidays. I know you'll love the service. We're committed to your ongoing satisfaction. Just have to be systematic about following this stuff and taking advantage of whatever the markets offer in 2019 and with the BOGO 2020 as well. We got you covered for the next 2 years. So take advantage of it. I'll hand it over to Jeanette so she can keep it going and wish you all a very Merry Christmas and Happy Holidays, however you like to celebrate it. Jeanette, thank you so much.